Well, those are the headlines that we are tracking for you all evening on ET Now. Well, first up, let's talk about the topic at hand, and that is index funds and passive funds. What exactly is the contribution they provide to your overall portfolio? Who should invest in it? Let's understand all of this. We have with us today Mrin Agarwal. She's the founder director of FinSafe. Mrin, thanks so much for taking our time today for us on the Money Show. Mrin, the reason why we decided to sort of poke this topic is because we've seen a lot of mutual fund houses in these last few weeks, in these last few months. Firstly, new fund offerings have, of course, hit the roof. But particularly in this index fund category, we are seeing quite a few, and not just in the large cap space, but in the mid and small cap space as well. Aditya Birla has one, for example. Tell us how they contribute to a retail investor's portfolio. What role do they play in a retail investor's portfolio?
Good evening, Mubina. Nice to be here today. Well, I think index funds do have a place in an investor's portfolio, given that they are passive, which means that, you don't have to worry. They're going to follow and do what the index is really doing. So it's really meant for investors, who do not want to think too much, who don't, want to do too much of research to figure out which is a good fund to buy, and who just want to go along with the index. I think it's good for those people. And I generally feel that index funds are a good substitute to an actively managed large cap fund as well.
Okay. So, why do you think that they are a good substitute? I mean, have you seen better returns maybe in a passive fund versus an active fund, especially in the large cap space?
Actually, if you compare the returns and the standard deviation as well, and if you look at most of the other ratios also, for example, information ratio, or even if you look at the Sharpe ratio, I mean, overall, you would see that large cap index funds, which let's say track Nifty 50, have given very similar returns to what actively managed large caps have given, with a similar amount of volatility as well. So that's why I feel that it's a good substitute to just go in for an index fund as far as your large cap exposure is concerned.
Okay. How do the expense ratios, differ? Let's just talk about large cap only, and then we can shift our focus to mid and small cap. How do the expense ratios differ? And, actually the question also is, do they really matter, especially if, and I'm sure most of our viewers are long-term investors?
So, I mean, certainly the index funds do give you much lower expense ratios because it can range between 0.2 to 0.4, let us say, on the direct plan. And if you were to compare it to an actively managed equity fund, an active managed equity fund would be anywhere between 0.75 to 1 to 1.5% higher than what you will get on an index fund. So, I mean, certainly there's a huge amount of difference in the expense ratio, but I still think that, it's important to also get a couple of things right, because what is normally being seen is that people tend to track only the large cap index. So they'll go in for a Nifty 50, but they're really not diversifying into other indexes, right? So I think, some of these other factors are also really important. And it's not only cost that one can go by when one chooses a portfolio strategy.
All right. What about small and mid caps? I mean, Mrin, you've mentioned that, yes, this is definitely a strategy worth considering. Passive funds are worth considering, especially if it's in the it's a large cap fund. But what about for small and mid caps?
Well, actually, in small and mid caps, even if you look at long-term data, you look at rolling returns over let's say a 10-year period, you find that the small and mid caps, actively managed small and mid cap funds, have had a much better outperformance as compared to the Nifty 500, basically, keeping Nifty 500 as a common index, right? So certainly the alpha generation is much higher in the mid cap and the small cap space. And hence, I would always say that for large cap, go with the index. But as far as mid cap and small cap is concerned, go with actively managed funds.
Okay. All right. So when it comes to mid caps and small caps, perhaps actively managed funds, could be a better option. But for large caps, an index fund definitely does give, a good and lucrative option. Do you think then, Rind, that the entire large cap portion of the portfolio can be replaced completely by an index fund or a passive fund?
Yes, why not? I would think that it can be replaced. I mean, again, when you look at the data, there's this general feeling that index is better than the actively managed large cap, maybe in the last 5 years. But again, when you look at rolling returns data, there are cases where index is also underperforming the actively managed funds, and that's really because of the weightage of the stocks. But yes, I think on an overall basis going forward, yes, I do think that the index fund can replace the large cap portion of the portfolio.
Mrin, what's your view on all these, passive funds or ETFs as we call it, which have come about for even thematic, for example, a tech ETF or a pharma ETF. Gold ETF, of course, is extremely common, and many do use it for as their investment in gold, as paper gold. But do you think that it may be a good idea if somebody is really lured by the temptation, lured by investing in these themes, because thematic funds have really been the flavor, right? I mean, last year it was all about tech and pharma. Given the fact that costs are low in a passively managed fund, could that be a good approach then to taking the thematic investment route?
Well, not for everybody. I think, these very concentrated and focused themes work well for people who want to take that sort of concentrated exposure, and who believe that that particular sector or theme is going to, really give them big outperformance. Maybe they're like doing a tactical allocation. But, from a core portfolio allocation strategy, it just does not make sense to go in for any of these index funds which follow a theme or which are sectoral based. I think it's just better to stay away from those.
Okay, so thematic funds, regardless of whether they're actively managed or passively managed or ETFs, according to MRID, it's best if you, stay away from themes in general, because, they do tend to be, they do tend to depend a lot on, of course, what the market's mood is like. And if you really don't have the time to, sit and track the market on a day-to-day basis, or, track the news around the day-to-day basis, it could become a little difficult. Okay, so that's of course all about passive investing. Now the question, Bryn, is most of these index funds or passive funds follow a particular benchmark. So whether it's the Nifty 50 or the Nifty 100, whatever it is, or the Nifty 250. So how do you then essentially choose between the different indices? Keeping it with large caps only, because like you mentioned, for large caps it's a good strategy. So how do you choose the underlying then? Is there much of a difference between, let's say, a Nifty 100 or a Nifty 50, and even for that matter between two mutual fund houses which may be tracking the same index then?
So I think the first thing is that if you're very clear that you want to follow a passive investing strategy, which is only going in for index funds, then clearly, of course, you need to have the Nifty 50 index fund or ETF. I also believe that Nifty Next 50 is a good index to have because it's the next 50 stocks by market capitalization. It's certainly more broad-based. It's basically growth stocks in defensive sectors. It's also more balanced in terms of the sectoral allocations and also in terms of the stock weightages as well. So I also believe that Nifty Next 50 is a good index, and then probably having the mid-cap index. So if you really want to follow only a passive strategy, then maybe a Nifty 50 with a Nifty Next 50 and the mid-cap index could be something that you could look at. With respect to how do you choose within the fund houses, well, clearly look at the expense ratio and look at the tracking error. All of this information is available in the fact sheets of the respective mutual fund. So of course you need to check the expense ratio and the tracking error. So tracking error is really the difference in the return between the index and the index fund. And it happens because of costs. And it also sometimes happens because of the way the funds are deployed and stuff like that. So these would be two parameters that you would choose, that you would look at when you are deciding between fund houses.
Understood. You know what? I think we'll just take a very short break. Mrind, request you to stay on with us. And folks, of course, if you have any questions or queries, now is the time to shoot them to us. Our email address is themoneyshow@etnow.tv. So while we wait for the question queue to assemble, we'll take a very short break and be right back.